let's look at the sale of let's just look at a basic cash transaction. So let's just take an example where, say, Best Buy sells a TV to a customer for $1,800. So the customer pays cash, so when we increase our cash asset by $1,800, and then on our income statement we have sales of $1,800. Say on that Samsung TV the customer paid $1,800 for, we paid $1,200 from the manufacturer to acquire it. So we're going to reduce our inventory by $1,200 because it's not in our inventory anymore. The customer owns it. And then in our income statement, we're going to show that $1,200 is cost of merchandise sold. And then for our retained earnings, revenue increases retained earnings, expenses decrease retained earnings, so our net increase to retained earnings is $600. So let's look at an example of a sales invoice. So if you see in the upper right, there's an invoice number. That's a unique identifier of this particular invoice. And also the customer would put that invoice number on their payment, so that way you know what invoice to apply the payment to. We have our sold to, which is the customer that we're selling our stuff to. An order number. And then if you look at that May 29th date, that's the date of the sale. If you look directly under that, June 3rd is the invoice date. Then to the far left, our date shipped is June 3rd from Cincinnati, how we shipped it. And you see we have our what's called our credit terms, which is 210 net 30. What that means is they get a 2% discount if they pay within 10 days. Otherwise, it's due within 30 days. The 10 days starts from June 3rd, not from May 29th. Then in the last row, we see the quantity, what they're buying, the 3Com wireless card, the unit price, and then the total amount of $1,500. And the 2 net 30, that's called the credit terms. So that's to encourage your customers to pay sooner. So if they pay us within 10 days, they get a 2% discount on the $1,500. If they pay on any time from the 11th to the 30th day, they have to pay the full $1,500. So if we look May 29th, that's the original customer order date. June 3rd is the invoice date. That's when the 10 and the 30 days starts. And then our discount period is the 10 days. So that's June 3rd to the 13th in blue. So if they pay from the 3rd to the 13th, they get a 2% discount on their invoice. Which the 2% would be $1,500 minus 2% of $1,500. So if they pay within the days highlighted in blue, those 10 days, they only have to pay us $1,470 for their $1,500 invoice to exercise the discount. If they pay any of the days highlighted in pink, the 14th of June through the 3rd of July, they have to pay the full $1,500. So let's look at an instance where the customer actually took advantage of the sales discount. So the cash that came in the door was $1,470. Because the debt that what they originally owed us was $1,500, they only had to pay us $1,470. So we increased cash by $1,470. We decrease accounts receivable by $1,500 because the receivable on our books was for the full $1,500 when we made the sale. But they only had to pay $1,470 because they took the discount. So you're thinking, well, our accounting equation doesn't make sense. What's the offset? The offset is we put sales discounts on our income statement, which sales discounts is you could kind of look at it as negative revenue. It's what's called contra revenue. So positive revenue increases retained earnings, negative revenue decreases retained earnings. So we decrease retained earnings by $30 for sales discounts. And you can see our accounting equation stays intact. So let's take a look at what's called a credit memo. So what happened was we sold Crier Company a graphic video card, and they're sending it back. They want a refund. It didn't work. They didn't want it. Anything like that. We're giving them a return. They're returning some merchandise, and we have to credit. So we're going to decrease accounts receivable by $225. We're going to increase our inventory by $140 because